When it comes to trend reversals, the most common mistake is to wait too long and miss the entire first swing of the move. And sometimes there is no second chance as the trend reverses again. In this video, I will use a unique combination of Heikin-Ashi 3-EMA and MACD to create a setup that not only catches early momentum but also is helpful in managing the exit. For this video, I am using the eToro stock and I will be testing this setup on a 1-hour time frame. At this point, the price is making a bearish swing. As the price drops, the volume is starting to decline, which is usually a good sign that sellers are losing momentum. So let's start with our setup. First, we will introduce the Heikin-Ashi. If you have not used Heikin-Ashis before, they are really easy to use and work as really simple trend indicators that reduce market noise by smoothing price action. Back to our trading screen. Let's have a quick look at the normal candles. The price action here is a little inconsistent, lots of noise, mixed wicks and no clean structure. We switch to the Heikin-Ashi candle. Instantly, the trend looks smoother and we can get a much clearer visual of a sustained bearish move followed by a reversal attempt. This is where Heikin-Ashi can be really useful in swing trading. Let's introduce our next indicator, the exponential moving averages. Before I add them, let's have a quick talk about the EMA. The exponential moving average is one of the most popular indicators in technical analysis and it's often used on its own as a go-to tool for identifying trends. So today we will be using 3 EMAs, the 50 EMA, 21 and 9 period EMA. They are really simple to add. Just go to the indicators menu, search for exponential moving average, add the indicator thrice and then adjust the settings and colors for each one of them to make them stand out and easier to use later on. But why should we use 3 different EMAs? The 50 EMA, which covers a much longer period, will be our primary trend filter and will help us identify if the price itself as a whole is in an uptrend or not. The 21 period EMA and 9 period EMA will then be our mid-term and short-term guides respectively. Now let's adjust the screen slightly to make them evident. I will start with the 50 EMA only to establish the primary trend. Here, price is clearly trading below it, confirming a bearish trend to start with. We will keep a close eye on the gap between the price and the EMA line as this will be our clue to potential shift in trend. A couple more candles and I see a strong bullish candle, and with it, price makes a strong move towards the 50 EMA line. Many traders will prepare to make an entry at this point, but here is the catch. Have a look at the volume. And it's clear that while the price made the move, it was not supported by volume, hence there was little interest in this setup at this moment. Another couple of candles and it is clear that the market did not support this move at this time. In fact, the volumes are even weaker than the previous candle. In this instance, our 50 EMA line acted as a strong resistance to this move. Good that we were patient and we did not fall into the trap. In case this move turns bullish, it will be normal to question that did we do the right thing by not entering the move? Smart traders always manage the risk. Another couple of candles and price makes another bullish attempt. We see 2 bullish Heikin-Ashi candles. The second candle closes above the 50 EMA line. Remember that for Heikin-Ashi candles to be really considered as bullish for our setup, there should be no lower wick. But what's even better, this time we have a strong volume behind the move. This is our first real sign of a potential trend change. When we bring back all the 3 EMAs, we see price above all of them now, with 9 EMA and 21 EMA starting to slope upwards. That's exactly the kind of momentum shift we want. Now another bullish candle, no lower wick, clean body, and it's still above all 3 EMAs. At this point, what we have a price that's above the 9 EMA, 21 EMA and 50 EMA, bullish volume support, and now a confirmed third bullish candle which is making a sequence with no bottom wicks. From here onwards, as long as the price continues to move above the 9 EMA and 21 EMA, we can rely on these two and assume that 50 EMA will slowly catch up. This is where I can consider opening a position. Ideally on the open of the third candle, and as clearly visible, this formation has clear support from volume. At this point, I will bring in the MACD indicator. Right at this breakout, the MACD line crosses above the signal line, which is a bullish crossover, adding a momentum confirmation to our setup. This is where the trade has alignment across all our tools, which is price action, EMAs, volume, and now the MACD. So now I can open my position at this point with a lot more confidence. My stop loss would go just below the recent swing low, and I would aim for at least a 1 to 4 risk to reward ratio. From here, my rule is simple. As long as price stays above all 3 EMAs, I keep trailing my stop loss, and I will keep a close eye on the MACD histogram for a potential signs of bearish crossover. So what am I trying to do? I'm trying to spot early warning signs before the reversal hits and take away my profits. Usually our first clue is an unusual bearish Heikin-Ashi candle after a sustained run. On its own, it's not enough, but at this point it also coincides with the following. Price is closing below the 9 EMA for the first time in this entire run, and MACD is starting to roll over with a sharp drop in the MACD line. That's my first signal of caution. I will tighten my stop loss at this point, and even if I misread this as a reversal instead of just a pullback, I am happy to walk away with my profit rather than hanging around for too long and taking a loss. Remember, I'm much ahead of my 1 to 4 risk reward ratio which I started with, as I have been trailing my stop loss. But let's say if I had not closed my position, this is how the setup would have turned out to be. Had we not closed our position, a big portion of our profits would have eroded. Now let's take a step back. Once we had seen price closing under the 9 EMA and 21 EMA with a strong MACD bearish crossover signal, the bullish phase was over. From there onwards, the chart started drifting downwards and the trend shift was confirmed. This is how we can use the 3 indicators together to not only catch early moves but also manage exits with precision. I hope you liked this video. Please drop your feedback in the comments below and let me know if there is any particular setup that you would like me to cover in a future episode.